We need to start from the fact that Omicron affected global growth already in the beginning of the year, and we had to revise our growth projections by 0.5 percentage point. And then comes this war. It is devastating for the Ukrainian people and their economy, likely to shrink up to 1/3. Very bad for Russia. Russia is slipping into a deep recession. The exchange rate shrank, meaning that purchasing power of the Russian people diminished, and the spillover impacts from the crisis there go fast and go far. They are most dramatic for the neighboring countries because they have trade relations with Russia, remittances, and of course flow of refugees. But they are also very bad for the rest of the world. Energy prices are up. They very quickly translate into inflation. Food prices, because of the role of Russia and Ukraine in wheat, in corn, are up, and that hits the most vulnerable people the hardest. So what we are faced with are two macro consequences. One, growth, instead of going up, which is what we want to recover from COVID, is going down. We would be revising our projections downwards, but they would still be growth projections in positive territory. Two, inflation is accelerating. That is pressing central banks to tighten financial conditions, and that would impact countries with high level of debt quite dramatically. When we entered the COVID-induced crisis in 2020, at that point, countries had to borrow just to maintain the functioning of their economies, but the cost of borrowing was very low. In fact, they were paying less, borrowing more, because of interest rates dipping, in some cases, below zero. Now the opposite is happening. Interest rates are going up, and that is going to cause tremendous difficulties for quite a number of countries.
But the worst case scenario isn't a stagflation scenario.
So we have to be, first let's start from a definition. What is stagflation? High inflation, low growth. Not necessarily it means negative growth. We might have some countries that face stagflation because they were yet to recover from the COVID crisis, and this shock hits them, holding them further back, and inflation is speeding up. For the economies that have already recovered from COVID, and the United States is one example, but there are many, the risk of stagflation is much lower. Why? Because they have already reached their pre-2019, pre-COVID levels.
Then which countries are at the highest risk of stagflation?
Well, it is very easy to do the list by looking at the countries that are high importers of energy, and where they have higher dependency on food import from Russia and Ukraine, where the 2019 levels have not yet been reached. I always prefer not to scare audiences. I can tell you that this would be the dividing line. Have you recovered to 2019? Yes, no? And how dependent you are on imports of energy and imports of food.
So, in this aspect, do you think that moving forward, central banks should focus on, it's always the dilemma right now, should they focus on growth or should they focus on taming inflation? And I'm talking here about the central banks of Europe, UK, and the Federal Reserve.
So we need to recognize that inflation goes with different speed in different parts of the world. The US is experiencing higher inflation. Why? because they recovered very robustly, demand shot up, but supply interruptions created a mismatch between demand and supply. For the US, the critical question is how to tame inflation without jeopardizing growth. We are going to see a little bit more attention on the inflation side. Why? Because their growth fundamentals are strong. You go to Europe, there the risk of inflation was and remains somewhat lower, although the war in Ukraine is changing a bit this picture, but also the recovery of Europe has fallen slightly behind the United States. So there, this calibration is likely to be more kind of neutral vis-a-vis European Central Bank stepping up. They would be very careful how they step up. And you go to Japan, and Japan is still struggling to reach their 2% inflation target. They may reach it now in this new environment. So the policy, this is the most important message I want to convey through you, that countries have to calibrate their policies based on their country-specific circumstances. There is no one-size-fits-all. And we at the IMF are now engaged with our surveillance, country-level surveillance, to help countries answer your question, how to calibrate monetary and fiscal policy in this very complex environment.
What's the best approach for Europe? Because among all these countries, Europe would be mostly affected by the Russian-Ukrainian war, and it's suffering from unprecedented level of inflation. Do you think that the European Central Bank was late in dealing with the inflation issue?
Before the war, they did the right thing. They were in a position when the indicators that lead to more significant tightening were just not speaking for that. Labor market pressures were not there, and as I said, their recovery across the many countries of the European Union allowed the central bank to be more cautious. The war is adding a very different element. But even with the war, the European Union has taken very interesting steps to improve their energy position by discussing with multiple energy suppliers, including some in this region, to make sure that they are easing the tremendous shock that comes from the war in Ukraine. And they have managed so far to allow the economy to continue to function. As you rightly said, inflation shot up. Why? Because energy price increase translates into inflation very quickly. There is no lag. And 10% increase in energy prices means 0.3% increase in inflation. So when energy prices shot, that of course caused the European Central Bank to assess what steps to take. My main point is action is data dependent. When the data tells you be careful, be cautious, you ought to follow it. When the data tells you inflation is hitting up to a point that central banks need to act, yes, they need to act. And then what is their fallback? It is fiscal policy. So if monetary policy needs to tighten up faster, then fiscal policy has to step up to provide the necessary support so growth doesn't collapse.
Mrs. Kristalina, if we look at the region, one of the countries that were mostly affected by this war is Egypt, because Egypt is highly dependent on imports, food imports, yes, from Ukraine and Russia. And the second thing is the increase in interest rates is leading to an outflow of this hot money that was invested in the local bond market. There are talks now for a new program with the IMF. How do you assess, first of all, the economic impact of this war on Egypt, and what's the latest on these talks?
It is really very unfortunate to see Egypt, that has done quite well in terms of reforming the economy, to be hit both by the food prices and their dependence on imports from Ukraine and from Russia, but also tourism. Many Russian and Ukrainian tourists were regulars in Egypt. What we saw was that the government and the central bank quite quickly identified the problem of outflows and pressure on the reserves. They took the right decision, which is let the exchange rate guide the market, and also a right decision to engage with the fund again. We are good partners. We have done well in the previous program. We are now engaged to see how we can support Egypt. For us, and we discussed this with the authorities, very important achievement in the previous program was better safety nets, more targeted social assistance. We want to be sure that this time around, when especially the problem is food and energy prices that hit the poor people the hardest, that we build a program that protects the most vulnerable population in Egypt reasonably well.
Do we expect the size of the program to be less than the previous program with Egypt? When do we expect to know anything about this?
Data-driven decisions. We are now receiving the data from the Ministry of Finance, the central bank. We need to assess what the needs are, and as I said, we are a reliable partner of Egypt. We are a reliable partner to all our members.
And other than the safety nets, any other requirements from the IMF to Egypt regarding exchange, the exchange rate?
We would like to see the country protecting the sound fundamentals they have achieved, and that includes reserves that give the investors confidence. And as I said, let's see what the data would tell us, and then we can discuss the program. Happy to visit you again when that is done.
For sure, that's for sure. Also, another country that the IMF is negotiating with is Tunisia, is negotiating on a possible loan from the IMF. Investment banks are warning that if Tunisia does not get a loan from the IMF, it might default on its loans. What's also the update on that matter?
So the update is we had a team in Tunisia. Tunisia came up with a homegrown program. They have defined where they want to take the country to, and our team has been working on understanding what this program is and making sure that we can align and then support it in an appropriate manner. Very constructive engagement. No final outcome yet, because their program is relatively new, and our team needs to assess it. We want to support Tunisia. It is truly heartbreaking to see so many countries being hit once and then hit again, and Tunisia, of course, is among them. So our intentions are to find a good decision on the basis of their program and on the basis of our staff assessment.
Mrs. Kristalina, the IMF played a critical role in helping countries cope with the COVID crisis. What role are you playing in this crisis?
I am very proud of the staff of the IMF because my colleagues truly stepped up. We have done more and faster than ever in our history, and for many of our most vulnerable members, that was virtually a matter of life and death. Now we are faced with another shock. The first thing we did was to support the Ukrainian economy because, as I said in the beginning, it is the hardest hit by providing $1.4 billion of emergency financing. We are also speeding up the work we have already started with members that receive special drawing rights. Remember, we distributed $650 billion of reserves. For some of the wealthy countries, they don't need these reserves that we provided for them. So we are asking them to on-lend it through us to low-income countries and to vulnerable middle-income countries. We have already secured 60 billion of pledges. This is growing even in this couple of days I have been here in the Gulf. And we are also identifying who are the most vulnerable among our members, because we have $750 billion lending capacity. If countries need us, we are there for them.
We are hearing from central banks and governments around the world. They're becoming increasingly concerned about the use of cryptocurrencies for money laundering, for avoiding sanctions, for financing terrorism. What is your opinion on this?
I share this concern. I think we have underestimated the speed with which digitalization is going to impact the world of money. Cryptocurrencies do need to be regulated. They cannot be left entirely outside of oversight. Why? Because they are expanding their share in transactions that are made. But more broadly, we have to recognize that digital money is going to take a bigger role in our lives. Central bank digital currencies are already emerging, and many privately backed stable coins are taking a role. But let me say it simply, some are more stable than others. Some are really backed with assets, some are pyramids that are sucking blood from people that don't understand the world of money. So our duty is to work on central bank digital currencies so there is interoperability, they can talk with each other. Very important to regulate stable coins and to regulate the world of crypto.
But would that be on the expense of the supremacy of the dollar? Some here are questioning that, especially after the sanctions on the foreign currency reserves of on the central bank of Russia and the SWIFT sanctions. Some are questioning actually the supremacy of the dollar in foreign currency reserves and in world trade. What are your thoughts on that?
So don't rush to say goodbye to the dollar as a reserve currency. All this talk about the demise of the dollar, premature. Why? Because the dollar is preferred as a reserve currency for the sound foundation of the Federal Reserve being a very independent and highly professional institution, US Treasury, the deep capital markets on which the dollar is based. Of course, as the world evolves, there are other opportunities to build reserves, and we have seen in the last decade the dollar as part of reserves shrinking from 70 to 60%, still 60%. The question is, what filled the 10%? Well, primarily Australian dollar, Swedish krona, Swiss franc, only 25% is RMB. Why? Because these currencies have shared the same attractiveness of strong, transparent institutions, trust in the fundamentals. Now, digital doesn't mean pushing away the dollar, because the United States has started the process of looking into a digital dollar. Of course, once the world of digital money expands, there may be some shifts. But again, people trust currency when this currency is backed solidly by institutions and assets. And this is still the case when we talk about the US dollar.